Hello and welcome to another Finder Insights video. I'm Graham Cook, the head of consumer research at Finder, and just 4 weeks ago we made a video looking at the potential for a bubble forming in the housing market in Australia. And in those 4 weeks, what looked like a healthy fire under the belly of the housing market has accelerated into a full-on blaze. So in this video we're going to take a deeper dive into that topic, and we're going to look at the effect of COVID-19 on consumer behaviour in Australia, what economists are saying now, and what this could mean for the housing market. But first, let me show you how crazy things have become. We're going to have another look at the same data we looked at the beginning of the last video because more information is now available. This is a chart of owner-occupier borrowing in Australia from 2017 to August 2020. As you can see, it never exceeded $15 billion in any given month. This is the money people are borrowing from banks in order to purchase housing. And since then, over the last 6 months, in this chart, you can see that it has broken through that ceiling and stayed above it every single month. The last 6 months have seen more borrowed than any previous 6-month period in history. So this is definitely a sign that the housing market is accelerating yet again. What's behind this? Is it about to burn itself out? That's what we're going to look at right now. The performance of the housing market, like any market, is driven by consumer behaviour. And in order to look at what might happen in the future, we can learn by what happened in the past. Thankfully, in Finder, we run a survey called the Consumer Sentiment Tracker, which we design and run in conjunction with Qualtrics and SAP. And we look at 1,000 Australians a month and ask them about their spending and general behaviour. We have 24 months of data in this survey, so we can use that to look at what happened in the past and what might potentially happen in the future. The first thing I want to look at from this survey, though, is pretty simple. It's Finder's happiness index. If you look at this chart, this represents the percentage of responses to the survey who said they were happy at the time of actually filling in the survey. It sat around 78 to 79% for the 12 months up until April 2020, and then took a serious dive down to 69% and has recovered pretty significantly since. The shaded part of this graph represents the period between the first and last lockdowns in Australia, not including the recent lockdowns in Western Australia. But as you can see, as we've emerged from lockdown, generally people in Australia feeling happier than they were before. Another positive metric I want to look at from the Consumer Sentiment Tracker is what people say they're saving every single month. Now this, before COVID-19, if you look at this chart here, hovered around the $700 mark, though it bounced up and down slightly. We're asking people here how much they're putting into a savings account every single month specifically. And since then, in April, it started to increase and actually peaked at a top of $1,000 around June in 2020. We've never seen anywhere near the amount of money people are saying they're putting into the banks. And since it's dropped back a little bit, but it's still relatively high at $889, much higher than it was before COVID-19. So people are saving an awful lot more. This could potentially be leading to increased savings available for deposits and in turn fueling the housing market. But overall, it's good to see people saving rather than spending. The final metric we're going to look at before we get into property is employment and jobs. We asked the respondents to our survey if they expect that they're going to receive a pay increase of any size in the next 12 months. And this is the chart of the responses to that question over the last 24 months. As you can see, for the 12 months up until COVID kicked in, it hovered around 50% of Australians saying they expected some sort of pay rise in the next 12 months. That then dropped dramatically to 36% in April and remained relatively low during the lockdown period of COVID-19, but has since again recovered and now sits at 55% higher than it did before the pandemic. So Australians, more than half of Australians, expecting some sort of pay rise in the next 12 months. The next two questions from the survey focus specifically on property. This first one is Finder's Property Positivity Index. We asked respondents if they think now is a good time to buy housing in their area, and this is the results over the last 24 months. As you can see, it bounced around between 55 and 60% of people saying now was a good time to buy before COVID happened, and then in April dropped dramatically to 40% and then started to recover as people realized the fears that the housing market was going to collapse through the floor weren't actually going to come to fruition. People were starting to take advantage of those low interest rates and low prices and started grabbing property across the country. But then prices started to increase, as we have talked about previously in this video. And after the positivity index hit a high of 70% around the end of 2020, it's been falling dramatically since and now sits at a pretty low 50%. And finally, the last chart from the consumer survey we're going to look at is the Property Positivity Index when it comes to prices rather than whether it's a good time to buy. This is, do you think prices are going to increase or decrease in your local area over the next 12 months? And it's been on a bit of a roller coaster ride through the course of COVID-19. As you can see, most people thought prices were going to increase before April 2020, and then everything flipped dramatically on its head, with most people thinking prices were going to decrease. And then again, everything flipped in October 2020, back to positivity for price growth in Australia. And that's continued to go up and to the right, now sitting at 80% of people in Australia, far more than before COVID, think property prices are going to continue to increase over the next 12 months in their area. So that's what consumers think, but what about the experts? We also survey 40 plus leading economists every month in Australia, and we're going to look at their responses to the future of the housing market question next. So one of the things we ask our economist panel in Finder is whether they feel positive or negative about 5 different aspects of the economy over the next 12 months. And you can see in this chart the results for those 5 metrics over the last period of questioning. We asked for their positivity in terms of outlook for employment, wage growth, housing affordability, cost of living, and household debt. And as you can see, almost all of those have gone up and to the right recently and improved in terms of positive economic sentiment, except housing affordability, which has fallen from a high of around 60% in 2020 to a low of around 3% now. So economists fear that the price of housing increasing is making it out of reach of many potential first-time buyers, and housing affordability is going to become an issue. We then decided to dive a little bit deeper and ask economists whether this means that the house price rises we've seen in Australia could continue at the current rate. Is the current rate rise pace sustainable? Now, before we get into that question, I want to show you this chart here, which is looking at the wage growth in Australia over the same period that we showed you the borrowing volume growth in the chart at the beginning of this video. Wage growth, this is the percentage wage growth every single year on year, seasonally adjusted. You can see that it has been going down. So while property prices have been accelerating pretty significantly, wage growth has not kept pace with those property price increases. We asked economists, because of these two things, are the growth figures we're seeing in the market sustainable? And they were pretty heavily divided. 47% of the economists on a panel said that they were not sustainable, and obviously about half said that they were sustainable. Why? Well, we're going to take a little bit of a deep dive here into some of the comments from some of the economists on our panel to back up their calls on this question. Conflicting views among economists, to say the least. Angela Jackson from Equity Economics, who thinks the housing price increases are not unsustainable, said the price growth is a concern because it further erodes housing affordability and increases inequality, with Australian households spending more of their budgets on housing instead of other more productive expenditure such as education and healthcare. Leanne Pilkington, who also believes the house price growth is not unsustainable, said there are a variety of factors which contribute to house price rises, not least the constrained availability of supply, and though the rate of price growth may ease, the long-term outlook for housing remains positive. Dr. Andrew Wilson from My Housing Market said house prices have increased at a lower rate than incomes since 2017. Those are the economists who said the price rises are not unsustainable. What about those who said they are? Nicholas Frappel from ABC Bullion said the rise in private debt is not sustainable given current low levels of inflation and low wage growth, whereas Shane Oliver from AMP Capital said the pace of recent house price growth has been driven by reopening, ultra low rates and incentives, but it won't be sustained at this pace as rates have hit rock bottom. Craig Emerson of Craig Emerson Economics thinks that we are experiencing a housing bubble which will deflate when quantitative easing tapers off. Peter Boehm, economist, says affordability is a serious concern, especially for first-time buyers. Eventually, house price growth will reach unsustainable levels, and the likelihood of material downward price adjustments is a real possibility. And to end, we have 2 conflicting statements from 2 economists on our panel. Noel Whittaker of QUT says long-term house prices cannot outpace wages, whereas Jacob Madsen of the University of Western Australia says house prices are generally not related to wages, but acquisition costs, interest rates, cost of land and structure. Given that interest rates are likely to stay low in the next 2 years, house prices are likely to stay high. However, when interest rates eventually go up, along with the increase in government debt and the aging population, real house prices will start declining. So there you have it. Economists are pretty divided, but there is some fear among economists of a potential housing bubble forming in Australia, but obviously it depends on who you ask. To finish this video off, let's look at financial stress. Back to the consumer sentiment tracker, we ask Australians, how stressed are you with your current financial situation? So this might be a good example of showing us what all of the recent activity has done to people's financial stress. If you look at this chart here, this is the percentage of Australians who say they feel very or extremely stressed with their current financial situation. As you can see, it bounced around between 18 and 20% of Australians feeling stressed before COVID, and actually dropped all the way up to July 2020 as government stimulus kicked in and people felt a little bit more financially secure, oddly, when lockdowns happened, but since then has started to increase dramatically and has continued to go up into the right, and now sits at 26%. 1 in 4 Australians say they're feeling stressed about their current financial situation. So it's clear that the economic uncertainty we're seeing in front of us, and potentially increasing house prices, people not able to get on the housing ladder, people worrying that they're never going to be able to get on the housing ladder, is causing more financial stress in Australia. So that's the conclusion of this Insights video. If you're looking for more financial news and insights commentary, follow the Insights blog on Finder. One thing worth saying here is, even though the cash rate's probably not going to go up, it doesn't mean your home loan rate won't go up anyway. Banks tend to increase rates out of cycle when the cash rate doesn't move. If you want to know more on this, you can check out an article I've written for Money Magazine, which will be linked in the description. In the meantime, thank you and see you next month.